So the next thing to think about with the income statement is cash versus accrual. Cash basis would only include the cash received and used. Accrual would be the revenue from what was produced matched up with the expenses of producing it during the year. The advantages are that this provides a more accurate representation of the true income from the production during the year, and it also allows it to be compared across different years to see what years were more profitable and if we're getting more profitable or less profitable. The disadvantage is that the cash amounts are readily available from your checkbook, so to turn those into accrual amounts, we've got to make accrual adjustments, but it can be done and it's not that hard. So cash is easy because you can take the amounts from the checkbook. Cash is misleading. Accrual is more accurate because it gives you a true picture, and it takes the cash amount, so you have to make those accrual adjustments to them. So making the accrual adjustments. Accrual adjustments are the changes to the cash amounts needed to make the totals reflect the true accrual amount or the actual amount. So during the year, $120,000 of wheat was sold. At the beginning of the year, there was $20,000 of wheat in inventory. At the end of the year, there was $50,000 of wheat in inventory. What was the revenue from wheat produced? And if you think about that, our cash amount is this $120,000, but it doesn't reflect the amount of wheat that was produced, and so we need to have an accrual adjustment to that. We know that at the beginning of the year we had $20,000 and that at the end of the year we had $50,000. So between the beginning and end of the year we added $30,000 worth of inventory to the wheat. So a positive $30,000 change in crop inventory added to the $120,000 is going to give us the revenue from wheat produced. And so that would actually be $150,000. The change in crop inventory is the accrual adjustment. In the revenue section, it's found by taking the ending amount from the balance sheet, subtracting the beginning amount. Sometimes it can be negative, and the appropriate current asset accounts are used. For the expense section, we use both current asset accounts and current liability accounts and adjust them. Current assets include supplies, prepaid expenses, and cash invested in growing crops. And the accrual adjustment is the beginning amount minus the ending amount. For the current liabilities, things like accounts payable and accrued tax, we use the ending minus the beginning. So here's another example. A farmer sold $100,000 of grain this year. He had a grain inventory of $20,000 at the beginning of the year. The grain inventory was $25,000 at the end of the year. So what is the farmer's true revenue from grain production? And the other question would be, what would be the accrual adjustments to the income statement be? And if you want, you could actually pause right here and figure that out, and then I will go on with the answer. So the farmer's true revenue from grain production this year is $105,000. The $100,000 that was sold plus the additional $5,000 added to inventory. Started out at 20, went to 25. The accrual adjustment is going to be a change in crop inventory of $5,000. The ending, $25,000, minus the beginning, $20,000, gives us positive $5,000. And this change in crop inventory is what would show up on the income statement in the revenue section.